If you've watched the news lately, you may have noticed that severe weather is getting worse and worse. Storms are bringing historic levels of damage even to places that were once considered relatively safe. As a result, the insurance industry is paying a hefty toll, losing billions to natural catastrophes year after year after year. In 2023, 18 of the top 20 insurance providers in the US had loss ratios over 100%, meaning they're paying out more in claims than they're collecting in premiums. And despite home insurance prices 35% higher than they were in 2021, insurers are still hiking up premiums. But what's this mean for America's already unstable housing market? Let's dig into America's insurance crisis.
We're talking about the price for home insurance. It's going up fast.
The wildfire triggered a visit from his homeowners insurance company.
2 property insurance companies are leaving the state of New York.
What impact will Helene have on insurance policies?
To understand this crisis and why premiums are spiraling, we first need to understand how insurers make money. And that's all about the law of large numbers. Let's look at a simple hypothetical. Okay, let's say an insurer covers 60 houses and charges each $1 per year to protect them. Of those 60 houses, one house will experience catastrophic damage, costing the insurer $10 that year. Another 5 will experience severe damage. Each will cost $5 that year. And then another 10 will need minor repairs, costing $1 each. A total of $60 in premiums collected versus $45 in losses, or a 75% loss ratio, $15 in profits. The insurer is making a bet based on averages, and according to the law of large numbers, the larger the number of policies they hold, the closer the outcome should be to the predicted average. But today's weather, it's not average. It's getting worse faster than insurers can increase premiums. Looking at the same 60 houses, here's the new reality. 2 experience catastrophic damage, 8 experience severe damage, and 15 need minor repairs. The cost to insurers is now $75, a loss 25% higher than the premiums they collected. Now, if this was a once-in-a-lifetime catastrophic event, insurers could go to their insurers. Yes, even insurers have insurance. The problem is that weather isn't just more severe, it's more frequent. This drives homeowners to make big claims more often to primary insurers, who then go to their reinsurers to cover these unexpected losses. Not wanting to lose money, reinsurers either stop offering coverage or raise premiums on primary insurers, who then do the same to homeowners. Now at this point you're probably wondering, okay, this is happening in states with really bad weather, like California and Florida, but it's not gonna happen to me, right? My state is totally fine. Well, let's go to the weather to find out.
Thanks, Chris. Home insurance premiums are increasing across the country, with Louisiana down here leading the pack at 23%, Maine at 19%, Michigan at 14%, and Utah over here at 13%.
Chris, I can understand why premiums are going up in Louisiana with all the hurricanes in the Gulf, but what's going on with all these other states?
Glad you asked. Now, over here in Maine, the state's climate scientists are expecting a 1.5-foot rise in the sea level by the year 2050, with each foot expected to increase coastal storm frequency by up to 10 times. Now, Michigan, on the other hand, is experiencing these things called convection storms. This is hail, hurricane winds, and extreme flooding.
And what about Utah? What's going on over there?
Now, the risk of wildfire is spreading to more and more states. 1 in 6 Americans live in an area at severe wildfire risk, with Utah being in the middle of it all.
What's important to understand about all of this is that insurers are becoming unprofitable in more and more states every year, even with increasing premiums, resulting in the insolvency of some carriers and the financial downgrading of others. And although severe weather is the primary driver, another key factor that's compounding costs is inflation. Homes are more expensive than ever before, and the costs to repair them have gone up significantly. Just look at how roof costs are going through the roof. Set myself up for that one, didn't I? With insurers exposed to more risk and higher repair costs, it's no wonder why they're increasingly asking for higher premiums from homeowners. While most states try to protect homeowners by overseeing rate increases, states are increasingly giving in to the demands of insurers. The risk is simply too costly to ignore. And when insurers can't collect the premiums they need, they get skittish. For example, you know Jake from State Farm?
Like a good neighbor, State Farm is there.
Well, he's not always there. Sure, State Farm is the largest home insurer in the United States, but back in 2009, State Farm left Florida and 1.2 million policyholders after a rate hike of 47.1% was turned down by regulators. Now, California is facing a similar challenge, with State Farm requesting a 30% increase on its homeowners line. It's incredibly tricky. Regulators must strike a balance between protecting homeowners from skyrocketing rates while also creating an environment where insurers can profit. If rates are too high, then people don't pay or even leave. If rates are too low, insurers take on losses and leave, meaning people lose coverage, or in some cases like Florida, public insurance programs are overrun.
Insurance plays an essential role in society in accurately measuring and pricing risk. When you have a government insurance program that subsidizes those costs, then you're encouraging overbuilding. And you don't want to mask the environmental risk signals. We need to recognize that as society and address it, not subsidize and suppress the rates.
As a result, homeowners are in a lose-lose situation with fewer and fewer options. Let's look at each of these in more detail. To start, number 1. Pay higher premiums. Seems reasonable to a point, but the question on everyone's mind is, how much will premiums go up? Arizona has experienced one of the worst cases, with homeowners insurance premiums having increased 62% since 2019, and it's still going with an expected increase of 7% in 2024. Not everyone can afford these drastic increases, especially lower and middle income families with less savings. And so we have to go to option number 2. Downsize. Problem is, there's a lot of friction in the marketplace that's making this easier said than done. For instance, if you're struggling to find affordable insurance options, potential buyers, they will too.
Now you're having to calculate that insurance early on. So people who thought they were going to buy a $550,000 house may now only be able to afford a $450,000 house.
And so we move to option number 3. Reduce coverage. Taking on a higher deductible and making as few claims as possible is what most insurance brokers are recommending for those trying to reduce the cost of their premium. But as traditional insurers leave, people are being forced into less comprehensive insurance plans. The lack of transparency and, more importantly, standardization is leaving many Americans underinsured, meaning they've accepted certain limits that will not cover the cost to rebuild or repair their home. Whether they know it or not, it's a dangerous place to be. The combination of rising costs, inability to find insurers, and struggles in finding a proper policy are sending more and more homeowners to the most dangerous option. Number 4. Forgo insurance. 6.2 million Americans do not have homeowners policies. If they lose their home to severe weather, the value of the home will be lost entirely. Those left with this option are primarily low to middle income families and disproportionately people of color. It's a big risk, especially considering that homes are the biggest source of wealth for most Americans, but the largest risk is to the economy. With these uninsured properties valued at $1.6 trillion, let me say it again, $1.6 trillion in unprotected market value. It's a lot of money, and that kind of loss could ripple into the broader economy, upending banks, governments, and America's already unsteady housing market. But let's say that's the worst case scenario, and focus instead on the question we asked at the beginning of this video. How are rising premiums going to impact America's already unsteady housing market? The short answer is, more and more Americans are going to be priced out of homeownership. In a survey of 418 housing providers, 52% said they're considering decreasing or postponing investment due to higher insurance premiums.
We have to rethink our housing shortage. It's not just that we're down 4 million homes, we're probably down more homes when you take into account climate resiliency and updates that need to be made to the existing stock of homes.
The point is, even if a family has a home and a good mortgage, they could lose it if their insurer leaves or increases the rates. And when developers see how low and middle income families struggle with paying insurance, they pause investments in affordable housing, which makes it even harder to buy a home. So exactly how can this crisis be solved? The best answer will be to stop building homes in high-risk areas, but Americans are doing the opposite. Although Vermont has the lowest insurance premiums in the country with relatively low risk, the population is decreasing. Meanwhile, Texas is seeing its population boom despite the increased threat of winters, hail, tornadoes, and hurricanes. So we have to wonder, why are Americans ignoring the risk? Home buying is a nuanced process with all sorts of factors to consider, from being close to family to being close to work to questions like how are the schools and what will my taxes be? It's true, more and more Americans are considering the impact of climate change, but it's far from their top priority.
This means the scale of the damage and destruction from natural disasters will continue to grow and become more costly, meaning that insurers will have no choice but to continue increasing premiums.
So, how else can we mitigate the risk?
Homeowners really need to be focused on preventive maintenance. People like to paint their house and get a new countertop. They don't like to do the dirty job of the maintenance of the foundation, the caulking, the ceiling.
And the bigger things are often at a community level. Because it's one thing to navigate flood away from your own home, but it can often be better if there was some community solution to navigate water away from an entire community or to keep fire away.
Other things like early warning technologies and stricter building codes have also helped reduce disaster risk and losses.
But what will make insurers feel even better while watching the Weather Channel before bed at night? A reliable reinsurance option. Remember reinsurers, the insurers who insure your insurers? These are global entities that help your insurers cover unexpected and big losses. And in 2023, their rates skyrocketed. This drove insurers to ask states for premium increases to homeowners, which states couldn't really deny. That's why many regulators are now calling for more regulation of reinsurance, and some are even looking to establish a national reinsurance program. Other reforms at the state level are beginning to take shape too, with everything from increasing the speed at which rate requests are approved, to updating the models by which insurers price risk, to more frequently inspecting buildings near coast to ensure they're structurally sound. But as long as the risk persists, the American dream of homeownership is going to be less attainable. The good news, the first step toward any solution is recognizing there is a problem. And as more and more Americans struggle to pay for coverage, insurers and regulators know something needs to change.